let's review holistically. So we trade VIX as really an answer to what do we do when nothing happens. This is a trade that I kind of invented in 2017 when the VIX or an S&P was realizing something like 6 and the VIX was, a low of 8 and change. What do you do to make money when there's nothing going on? And what we do is we try to sell volatility in a risk-defined way. We also hedge that off in the bond market. Trade number 2, in no particular order, is the term structure of the 10-year note. So what we're looking at is the way the volatility surface within the 10-year note only is moving, not the way the yield curve is moving, which is also quite different. Now, we could look at other parts of the yield curve, but the reason we trade the 10-year note is dead simple, because that's where the most liquidity is. That's where most of the action is. So we can participate in the marketplace with less friction in the 10-year note than we can the 2-year note or the bill. The third trade would be vol arb, okay, which is, again, buying low and selling high and doing the best with that. And our fourth trade is a dispersion trade. So a dispersion trade is really a index versus the components of the index trade and how they go against each other. The old example is you have an index of 2 stocks. You have stock A and stock B. Stock A goes up 10%, stock B goes down 10%, but the index of A and B goes nowhere. So ideally, if you can sell volatility in the index of AB and you buy volatility in the stocks of AB, you make money in both names and you also make money in the index. So you make money thrice, because you make money in A by going up, you make money in B by going down, and you make money in the index by going nowhere. In addition to that, because larger players tend to come in the index volatility tends to get more bid than the individual constituents would price individually, because you get that whole bundling effect, right? So if you are an institution and you want to sell a bunch of S&P futures, it tends to go into the marketplace as a product as a whole, and correlation becomes bid. So dispersion trading is the same thing as saying correlation trading. So what we do is we try to trade correlation as well as the individual names themselves. So that is really our 4 main strategies, and they don't really have anything to do with each other. And again, common sense wise, where do these strategies come from and why do we trade them? They come from 25 years of prop trading. These are strategies that are scalable. They are not related to each other. They're not probably related to the rest of your book. So what we wanted to do is create a hedge fund product that is truly different and derives profit from totally unique sources and strategies that I think most retail or even institutional investors don't really get a chance to see.